Okay, you look over on the far left and you see July 17th. See, July 17th, the market opened and it went straight higher. Let's take a look at the top of the 17th. You'll see the market just going straight on up, and you see that kind of P formation. That's a sign of probably short covering, and the reason it's a sign of short covering, the market, if it was getting a combination of short covering and new business, which would be, short covering is old business because you're adjusting positions you already have. New business are new buyers coming in. If you had that combination, your profile would probably be elongated on the top. At the same time, you do not have a good high. So it's a low confidence situation. You come back to the 18th, and you'll see that the 18th opened within the range of the 17th, traded back up again in one of those P formations, and no real upside follow through. The 19th builds value lower. So now we have the potential for change. But notice that the high on the 18th is no good. In other words, it's a poor high because there's no single prints. We then come along to the 20th, and the 20th is an inside balancing day. Even though value is overlapping to lower, it's an inside balancing today. When we are looking at balance, the balance trading rules are as follows. Look below balance and extend lower. Look below balance and fail, coming back into the balance. When that occurs, then your destination trade is the opposite end of balance. Or, trade back up above the balance, look above it again, and either fail or extend higher. So not only do we have an inside day on the 20th, we are also in the 19th. So we have a 2-day balance. So instead of a 1-day balance, we're going to use a 2-day balance. And Jen, if you can mark the low, I think we have matching lows on the 19th and the 20th. So when you look at those matching lows, we have no excess on the low. Overnight or over the weekend, as the market reopens, you can see in the overnight market that the market trades off. Trades down near the low of the 17th, doesn't take it out. But by the time we open in the morning, the overnight inventory, which was very short, has come back up, and it's just about reaching the unchanged level from the 20th. But inventory is still short. Remember, overnight inventory, we take the close of the previous day, which would be the close on the 20th, and we see that the majority of trade took place below the close or the settle on the 20th. So overnight inventory is short. Remember, there's about a 65% probability, we're dealing with short-term inventory from overnight, that we will see a counter auction. A counter auction would be a rally to the upside. If the market doesn't rally, with the inventory being, short, then that's a sign of a day that's weaker than we think. If it does rally, then the issue becomes, can we get outside of the balance of the 2-day balance? All right, let's give it about a minute and let's just start to play. Hit the play button, and then what are we going to be looking for as the market opens? We really want to see what happens relative to the 2-day balance. Okay? If there's anything meaningful, we will get outside the range of the 2-day balance. And let's open it about 4 times speed. So we can go through this fairly quickly. One of the important things about balance, we're open right at the lower end of the 2-day balance. Remember, we said that there was no excess on the 2-day low. So the low from the 20th would have been a weak low because it was exactly at the low for the 19th. Okay, now we've looked below the 2-day low. The destination trade now becomes the upper end of the 2-day balance. That doesn't mean we're going to get there, but that is just one of the references that I'm looking at. Say if I look below balance and fail, then the potential is to the opposite extreme. If I look below balance and don't fail, then the odds are that the market starts to build value lower. So overnight inventory is short. We know there's about a 65% probability when that happens that the market will show correction. So right now we're running at 4 times speed. We're not getting any great confidence in here. We're back and forth through the opening, back and forth into the low of the previous 2 days. So with the market, with the overnight inventory short, we're not getting a counter auction to that, not at least so far. We're following through to the downside. So there's no, there's no real selling pressure or buying pressure in here. A little bit of churn right around the low of the previous day. So we'll just watch and see. We'll just watch and see what happens. We have looked below the low of the previous 2 days. If I'm short at this point, I want to have my stop, my buy stop, just back within the range of the previous 2 days. One of my favorite trades is when we re-enter a previous day's range. So right now, since the market's trading lower, I think the short-term trade is to the short side. The question is, how do you protect yourself? How do you monitor that trade for continuation? Well, the first thing, if I am short, I don't want to see the market come back into the range of the previous day. In this case, it's the previous 2 days. So I think the trade is to the short side, and then it's a question of how do you monitor for continuation. We know where to put the stop or where we want out, and now the downside objective would be the overnight low. So we watch to see, can we get down to the overnight low? We're just watching. We're, playing at 4 times the regular speed. So, it's looking a little more exciting than it actually was on the day. Remember, what I don't want to see, I'm short, I don't want to see the market back into the range of the previous 2 days. If I get back into the range of the previous 2 days, I probably want to try it to the long side. Now, we're talking about pretty aggressiveness, a lot of aggressiveness in here, but so many of you, or the people that we deal with, are short-term traders. And that means they're day traders or traders that are looking for 1 to 2 or 3 days at a time. All right, so the market has rallied back up to within a tick of, let's stop for just a second. The market rallied back up to within a tick of the 2-day lows. If I am short, and we're talking about monitoring for continuation, the minute that market rallies up to within a tick of the previous day's low, previous 2 days low, if that market gives me an opportunity and it breaks to the downside, I am going to immediately cover my short. I think the risk of being short is too high. If the market was really that weak, the market shouldn't be able to rally up to the exact level of the low from the previous 2 days. So again, talking about managing for continuation, I'm talking about what I would do. Now, there's no way to write that down. A lot of times people say, well, where would you put the stop? Well, I already told you where I'd put the stop. I don't always know, but in this case, I don't want it back into the range from the previous 2 days. But then I make mental adjustments. I watch the market go back up and tag the low. It's either one tick below it or right there. And I say, if the market was that weak, we shouldn't have gotten back there. So the first time this market ticks down a couple of ticks, I just use that opportunity to cover my short and step aside. Okay, let's continue to play. Okay, so we saw it touch the low. We saw it sell off. And now we're back in. We traded one tick back into the range of the previous 2 days. Remember, the power of observation is so important. To be able to see those little nuances that I'm talking about. You have to train your mind. You have to train your mind to see those things. Hold on just a second. Let's stop for a second. What can happen to many of us, we get so focused on price that we forget how to look at a market. The previous day's low, and particularly since it's a matching low, is an extremely important short-term or day time frame reference. Will it touch there and always, go back up? Not necessarily. But if you're talking about odds, when that market trades off, you don't want to be there. It's just, the trade's just not worth it. Okay, let's play. Not a lot of conviction. But the market has tried to trade off. And you see they're selling almost every little rally. A lot of choppiness in here this morning. See, we're trading right around the half-back level from overnight, or the point of control from overnight, and the half-back level. Okay, we said twice before we've come back up to the low of the previous 2 days. This is the third or fourth time. Every time we get near that level, can you stop it for 1 second, please? Every time we get near that level, it's what I refer to as the semi-permeable membrane. Every time you hit a semi-permeable membrane, the weaker it gets. Every time that market goes up and it pokes the low from the previous 2 days, the matching low from the previous 2 days, that reference becomes weaker and weaker. Does it have to be taken out? No, but the odds are that it will be. All right, let's continue to play. Remember, I tried a short early. I don't know if I would have done that, but I'm just talking about trades. If we get back into the previous day's range, I will probably go to the long side. One of my favorite trades is when we exit the range of a previous session and come back in. Does it always work? Of course not. But I just find the odds to be pretty good odds. I have no short on. I mean, even if I did have a short on, the market doesn't show me the conviction on the downside that I want to see. Now, conflicting information is the overnight inventory is short and the market's still trading to the downside. You say, well, Jim, doesn't that mean it's weak? There's always reasons that, it could go both ways. And I just the ruling reason to me was we had a chance to break out of balance pretty hard from the 2-day balance. We didn't do it. We're out of balance. We are out of balance, but we've been back to the low of the previous couple of days 3 times. And that to me is just not a worthwhile trade. But yet you say, look at this, we're still trading lower. And this is where traders can start to second guess themselves. If I was short, I came out for a reason, trade's done with, I'm not going to second guess myself. But a lot of people will. They'll say, well, price is going lower. Boy, I wish I'd have kept that trade on. But I looked at the odds, we came back that many times. Okay, now we're back there again. So you see, I didn't think the risk on the short side was worth it. Now you see what's happening in here. We're back. Hold on, let's stop for just a second. If you were short, and I think that was the early morning trade, once it traded below the 2-day bounds, that market gave you a good 20 minutes to get out of your short. Market regulates itself via time. Now, it doesn't always give you 20 minutes. But if you stayed in your short and you didn't use that time to cover your short, shame on you. You had plenty of time to get out. There was no rush. Sometimes we have to panic out of the trade. But there was no panic out of this trade. We had plenty of time to get out. You saw my reasonings why. And, if we'd have been doing this real time, you said, well, Jim, but it went lower first. Well, guess what? There's no perfection to this market. There's a lot of people with a lot of different views coming in from all over the world. And there's going to be volatility and there's going to be chop. But I have my reasons for wanting to get out. I didn't think the confidence was there. Now we're back into the range of the previous couple sessions. We can play again, and you see we're now into the second period. We've got an excess low. Those are the single prints. See, the market is trading right about unchanged from the previous session. That's the green arrow down there, or the green circle. No excess on the high anymore. Okay, now we're starting to get range extension to the upside. Okay, the next reference will be the overnight high. So we just watch this play. If there's anything here, the market will, continue higher. It get well into the value area from the previous day. We have a combination of the point of control, half back from the previous day, and the overnight high, all fairly close together. You'll see the overnight high, and you'll see right below that, you see the half back level, and you see the point of control from the previous day. So those are kind of a composite of our upside reference at this point. We make a note that the confidence wasn't that high this morning. Remember, the market went down, came back up, went down 3 times. A lot of times, and you hear me say this over and over again, people want a tight first-hand definition of confidence. I don't have one. You get it by looking at the market. I can show you what to look at, and I can walk you through an example to say it didn't have the confidence either up or down. So it's a low confidence environment. It didn't have the confidence on the downside, and it's not showing us a lot of confidence on the upside. We're back in the range from the previous 2 days. The upside destination trade is the high of that 2-day balance. That doesn't mean we're going to get there, but that's just when I'm looking and I'm saying that's the ultimate target for this particular day. Then we watch to see, okay, what has to happen for us to get there? Okay, we have to get back above the overnight high, which, as we said, was a combination of references in that same level. Again, you see the confidence is low. Back into the previous day, and now we're exactly at the low from the previous day. And we're right above the opening. So a lot of chop in this market. Very difficult to make up your mind what to do. Remember, over and over again, there is absolutely no shame in not having a trade on in the market. Too many times, people feel psychologically that if they're going to sit in front of the machine, they have to have a trade on. They have to have a trade. They have to have a trade. And that is probably a pretty quick way to lose not only your money, but also your confidence. And confidence is so huge in the market. Part of building confidence is being able to walk away from a market, say, I don't like this market. I'm not going to trade it right now. And that's really the level of, personal conviction you have to reach. If you don't like it, you're not going to be there. Okay, we're back down. We just went back to, right at the opening. We looked down below the 2-day low again. No real acceptance down there. On the market's out of the range. Now, if I'd gotten long, which one of the trades I like, I would be out of the long too. Now, when I didn't have confidence, I might not have been there. I'm just saying, if I did have a long, when that market came back down in the range of the overnight that was below the 2-day lows, I'd have been out of that long. It's not worth it. So again, we have a low confidence day. Market is back and forth from high to low, in and out of the 2-day balance. We're within the overnight range. Now, once again, the market is testing lower. We show far more rotational days than anything else in the foundational course. The reason for it be, that's what most days are. Most days are rotational. Only a very small percentage, probably at the most, 10% of the days are trend days. In some periods of time, it'll be a little higher than that, but the majority of the days are rotational. And if you are a trend trader, it's a very difficult market for you. And what happens a lot of times, we're talking about even the bigger money. When the market's trending higher, say the long-term trend is up, they don't have a lot of problem. They just buy the breaks and they get long the market. When the market gets into a rotational environment, and the current market we're looking at here, stopped the long-term auction in December. And it has been moving sideways ever since. And that's what markets do. They go trend, balance, or trading range, back to the original trend, or trend, balance, or trading range, and reverse trend. Right now, the market is in a 7-month balancing market when you look at the bar charts. Okay, so again, we're back up to the opening price. And I've said it time and time again, and you'll hear it over and over again. You have to learn how to observe a market. You have to automatically see where the opening price is. You have to automatically see where half back is. You have to automatically see where the low for the previous night was, where the high from overnight, where the low from overnight, the point of control from overnight. Step one is learning to see and observe those things. The final steps are learning how to use them to manage trades. All right, so again, we looked below and failed. We looked above and failed. Now we've come back down and we've left a poor low. Poor low because there's no single prints on the row. And the market's continuing to trade lower. Value is building lower. So at this point in time, value is being accepted and built or developed below the low of the previous 2 days. So once again, we are out of balance. meaning we're trading outside of balance. It's still got the makings of a downside breakout. I probably am not involved in this market simply because it went down, failed, it went up, failed. At this point in time, I look at things like this and I say, you know, I'm stepping aside. I just don't understand the market and it doesn't have the conviction. And if I don't really have a good feeling for what the market can do, I don't want to be around. And this day doesn't give me that confidence. There's a lot of short-term traders that are over anxious to be involved in the market. And they have probably been both long and short, maybe long, short again today. And they look, by the time they paid commissions, they have no profit and they've expended an awful lot of psychological capital. Okay, Jen, let's speed it up a little bit. We've seen the lack of confidence. Again, the definition of lack of confidence, it's not written down, but we were, you know, below the low of the previous 2 days, back above it, back down below it. I don't know how you can say anything other than it is a low confidence market environment.
Is 10x speed okay?
Sure. So here we are. Now we're back up. We're back into the range. Let's stop it for a second. So this is the second time we're back into that range. Overnight inventory has not been corrected, but there's probably still a lot of shorts out there. And now, one more time, having looked below the low of the 2-day range and come back in again, you have to be very careful that there's not shorts out there waiting to cover and that there's not new fresh buyers. Again, a low confidence environment, back and forth between the low of the previous 2 days. I'm stepping aside. I don't have the confidence, even though, you know, you could get a big move. But if there is, I'll look for a trade later on. I shouldn't say look for, see if a trade comes to me. Okay, let's go ahead and play. Remember, the majority of days, probably 85, 90% of the days you get involved in are rotational days. They're non-trend days. They're rotational. The more rotational a market is, the more opportunities there'll be involved. But the more rotational a day is, the smaller the opportunities. So on rotational days, you want to think about, you know, shorter term trades, taking profits quicker, not waiting for the real home run. On a trend day, you want to get on the train and stay with it. So if the trend is to the upside, you want to be able to buy breaks and you want to stay with the rallies for a little bit longer. Bigger trades, less trades, but bigger trades, more profits on trend days. Okay, we've looked below the 2-day range. We're back in, low confidence, but one more time, we're back in the range of the previous day. You've got to be thinking, well, the potential is for trade to the opposite end of the 2-day balance. So we're now, you know, close to an hour and a half into the day. Just ask yourself, what is the value? What's happening to the value area? You know, it's building lower right now. What would it take to even, you know, start to get overlapping value? You'll have to get into the value area from the previous day and find acceptance. You haven't found that yet. So at this point in time, value is building lower. We've changed time periods. So the market's been bought several times as it sold off. So there's a tremendous amount of uncertainty in here. Tremendous amount of uncertainty. They bought, they took it back in. Now they look at that, they're back out of the range again. For me, when I see a day like this, it's almost an impossible day to trade. And I wanted to show you this day deliberately because there are just days you don't trade, and there is absolutely nothing wrong with that. Go trade another market, read a book, but when you get a day like this with lack of conviction, stay away. Too many times you get to the end of a day like this, and traders will look back, they'll be behind or have very little profits, but yet they will have traded the market multiple times. What happens when you do that? You've got the spread between the bid and the offer that you lose. You're losing on the commissions, and you're really tired yourself out. But traders will tell you that they're just panicked, that they'll sit there looking for a trade. They're looking for a trade. And if you look hard enough, you'll find one. I've been there. I've been trading over 40 years. There are none of these psychological moves that I talk about that are coming from a book. They're all coming from my personal experience. I can look on these days and I can feel the uncertainty. You know, I can feel what I went through. I can feel the desire, oh, I want to be in the market. I want to trade. I want to trade. And just think what happens when let's say you got a day like this with no real conviction. You want to trade, but let's say you've come into the day with a loss, from the previous days. Oh boy, you want to get that loss back. We find that people take, 3 times or 4 times the amount of risk to get even than they will take on any new trade. Psychologically, it's just unbelievable what we do to ourselves. Egos are so strong. We'll take almost unlimited risk to break even. All right, so we're getting well into the day. One more time, we're back into the range of the previous day. We're right at the lower portion of value. I do not use the lower portion of value, but I'm aware of where it is to see, are we getting acceptance or rejection back into the value area from the previous session. Okay, the market is squeezing itself higher. We have no excess on the high, so the market is continuing, and it's back into those 2-day ranges. The potential is still to the opposite end. It's a very frustrating day to trade. So I wanted to show you days that, they're not necessarily pretty, but they're days that can do a great deal of damage to you if you get, anxious or you get stubborn. Very dangerous type of environment. All right, so we're moving higher. We've been one time framing higher since the C period low. Notice that C period, D period did not take out the C period low. E period has not taken out the C period low, or the D period low. We are back in the previous day's range. Our next upside objective is the overnight high. And that overnight high is right around the point of control from the 22nd, right around half back, as well as the overnight high. So clearly the market is now looking at the overnight high. Let's speed it up just a little bit.
Is 15 speed okay?
Sure. So remember, we're going at a very, fast speed. At 15 times, it'll take us 2 minutes to play a half an hour. But at least you see what's going on. Notice that the market is one time framing higher. C period low, D period low did not take out C period. E did not take out D period. Like I say, I'm missing a good day in here because it was just the confidence was too low. I mean, I don't know if I would have gotten back on or did or not, but okay, we said now as the market started back up, the overnight high is the reference. And why is it the reference? One, it's very, visible. Traders love visible references. They don't have to think about them. They know they're there. And that's not meaning they got the right idea. It's just meaning this is what they do. So much of trading is appreciating the competition and what it is doing and how it sees the market. If you can see the market in a deeper sense than they do and understand what they're doing, it can put you at a very favorable edge. Confidence is still low. The high is poor at this point, and the high is poor because it has no single prints. The high is also weak because it's a single print below the overnight high. So you have a combination of both a poor and a weak high. The odds of that high lasting very long are very, very low. Very low because it's a poor high as well as a weak high. Remind yourself, what is a weak high? A weak high is a high that's right near a previous reference. A poor high, it's no profile exit on the top. Okay, now you can see what happened. Once it took out the overnight high, guess what was there? Stops. Very, very expected. You know, traders put their stops in, and instead of getting out ahead of time, it takes those out, their stops are hit. Once their stops are hit, that helps pick up the momentum. All right, we're now, the next objective will be the high from the 20th. No excess on the high, no single prints. Market elongating out. Well, this market looks like it's, got a lot of confidence now. It's looked above the overnight high and it looks nice and thin and elongated. They're terrible days to trade as far as I am concerned. The market lacked confidence early on, considerable confidence. Now it's gone back and it's got some confidence. The next objective is going to be the high from the previous session. The market appears to me just to be too strung out now relative to the low confidence we had early on. When I say too strung out, it's very thin. When I see that, again, I don't have any confidence that I'm going to get a lot on the upside. So on a day like this, I am more than likely not trading. It may look easy now, but very difficult, earlier. And what happens to a lot of traders that don't have the discipline to stay away from these days is they get worn out. If they get lucky, then they feel very good. But if they didn't get lucky and they got chopped up, they feel terrible. A loss of financial capital, as well as a loss of psychological capital. You've heard me say multiple times, both are important. I personally believe that psychological capital is more important than financial capital. Without psychological capital, you can't be in a wholesome decision-making process. Okay, so G period range was quite narrow. When you look at what most of the ranges for the day have been, G period is the narrowest trading range of the day. So we got up here and for all practical purposes, the market just stopped. What is that, about a 6 or 7 tick range? Very, very narrow.
2 points, 8 ticks.
Okay, 2 points, 8 ticks, okay? Extremely narrow. Now, H period is within the G period range. It's tagged the low. Again, remember my comment, it looked too stretched out relative to what had happened earlier for the market to show much upside. So if you got long in here because the market looked like it was starting to do something, it's awfully easy, once again, to get chopped up. Remember, confidence has been low from the first half hour. We could see it early on. And with low confidence comes a lot of chop. And you're seeing that chop in action here. Said it looked like it was too stretched out, too elongated for the day that we had. That too elongated formation usually happens as a result of short covering when it's from low to high, or it's just the fact a lot of short-term traders jumping on any price move. Okay, so no more one time framing. The markets come right back into the range from the overnight range. You probably would think that as part of the foundational course, we could certainly come up with days that, seem to be better than this to narrate. In my opinion, you probably can't find a better day to narrate and a better day to put into the foundational course. So you understand how difficult some of these days can be, particularly on the days when the confidence is extremely low. Confidence was low going down, going up, going down, going up. And even now, we started to look like it's going to do something. And then H period comes back down within the range of the overnight. Now, it went one tick below that, very mechanical. And now it's trying to go higher again. Very low confidence day. I've repeated it too often, but there is absolutely no shame in not having a trade on. A lot of you can say that makes a lot of sense, but when you get in the heat of the moment, you find that trying to have that self-control can be extremely difficult. All right, I think we've made the points we need to make. Let's speed this up. What speed are we at now?
We're at 15x speed.
Yeah, let's take it up to 20. So a half an hour will play in 3 minutes. But, we just watch what goes on. Confidence is low. The high from the 20th is still the upside objective. We have a poor high at this point again, and a poor high. Why? Because there are no single prints on the high. The range for G period was low, and now H, I, J, not a lot going on in here. Very choppy. Now we've been almost 2 hours, and the market's been in an extremely tight range. It looks more exciting when we're playing at the speed we are, but it's just a day that you pass on. And I think it's far more important to show you a day like this than it is to show, oh, look at this day. Here's what you do. Here's, and you say, boy, I come away. There's really some money to be made here. Well, the first thing about trading is playing defense. And these are the kind of days that playing defense means don't get involved. The confidence is low and you want to be exceptionally cautious. All right, so we said that the range or the target is the high from the previous day. Let's mark that previous high so we can just see where it is as the day goes on. If it got above that high, then the next objective would be the 2-day high. So it is rotational here. We went up and then H period came out, took G on the downside. J has come back up and taken taken the G period high. K period is within the J period range. So you consider how late in the day we're getting. we're not getting much upside extension. And the market's pushing, it's grinding, but there's nothing elongating out about this. I'll come back and make the point that this may be one of the most important days that you see narrated in this foundational course. Very low odds of making any money on days like this, but absolutely a day you should stay out of. Now, you know, people will come along in hindsight and say, oh, well, look at the market went up all day. Well, you know, when you get to the end of the day, so, oh, well, you buy it low and sell it high. Yeah, okay, I got it. But that's really not how it works. If you're a short-term trader in here, there are a tremendous number of challenges. So think how, you know, we're getting late in the day and we still haven't gotten to the high of the previous day. How hard this market is working to do that. K was an inside bar to L period, or to J period. L is within the K period range. So we're getting close to the end of the day. We have L, M, and then the runoff period and N. And we're playing it 25 times. So you can see that the market is starting to widen out at the top, which is more of an indication that we've been dealing with a lot of short covering today. Remember the previous day, you know, made the high early in the session and then closed down at end period. So you probably had a lot of shorts from the previous day because it was, you know, spent a lot of time heading to the downside. Overnight activity was short in the overnight market. And, you know, you got a little shorting in early in the morning, but now you get a little short covering, but you're not getting any new business, any new conviction coming into this market saying, boy, we really want to own it. We think this market's going higher. So look at L, look how narrow L period is. The contrast here, it's a terrible day to trade. But as I said earlier, it's a great educational day. So many times traders are so obsessed with making trades, they forget about playing defense. Playing defense requires that you stay out of a lot of trades. There are certainly times when you'd rather be on the sidelines. Let everybody else go in there and beat each other up. So it's you know, you go to sleep watching this day, right? But the educational value on a day like this is huge. Because when you get involved in a day like this and trading the day, you don't think about how little opportunity you really have and how much risk you're really taking. You lose sight of it. Oh, I'm going to buy it. I think it's going up. I'm going to sell it. I think it's going lower. And guess what? It's doing both. There's just nothing there. All right. So now we're in the runoff period. It looks like we had some short covering in here. So in the runoff period, which is end periods, the last 15 minutes of the day, and you see the market exploring to the upside, exploring the high from the previous session. So end period is now exactly at that previous high. Look at the stops. It got the stops up there. Okay, so the day is over. The move to the top is what I call a spike. This last move in the upside, even though it is the runoff period, is what I call a price spike. A price spike occurs late in the session, and there's not enough time left to verify if that was a good spike or probe to the upside or not. So the spike rules come into play the following day. The most positive response is to open above the top of the spike and remain there. That says that prices had not gone high enough to cut off the buying. Opening within the spike for the next session is positive because it's saying that that price spike is showing price acceptance. So you open and trade in there in the morning. The most bearish response would be if the market opens below the base of the spike. That would tell you that prices had gone high enough to cut off the buying. That would be a negative sign. Now, we take the base of the spike, and Jen, can you mark the base of the spike? The base of the spike is support for us in the following session.
Do you want the base right here?
Yeah, please.
950.
So that's a small support area that we use for the following session. Okay. Look at the profile itself. It's not a very exciting day. The shape doesn't tell us a lot, and the volume, was mediocre. So it's just not a good market. However, we looked up below the 2-day balance. Now we're trying to look at the top of it. We still have that 2-day balance. We did close outside of the range of the previous session. So mixed signals all around. All right. I hope this day is tedious as it was to walk through it. It is as important as any day in the course. Thank you.